Hey guys, we're going to talk about bank statement loans and DSCR loans today, and I have a special guest with us. I'm really excited to introduce him. He is with Lensure, and he is my account executive there. Lensure is one of our partners that we can take our non-QM loans to, and Tyson is going to talk to us about what makes Lensure a little unique when it comes to those. We're going to keep it pretty basic. We're going to talk about bank statement loans first, and we're going to kick it off with what a bank statement loan is. So, Tyson, can you tell us a little bit about bank statement loans?
Yeah, actually, absolutely. Thank you for the intro and for having me on. Excited to be here. So bank statement loans are one of the staple products of any non-QM company. Realistically, what we're doing with a bank statement loan is verifying income by using bank statements. So typically what our track is going to be is to take the prior 12 months, 12 to 24 months of bank statements from your business account, and we're going to spread those. We're going to look for patterns and categories of deposits. We're going to use consistent categories and deposit tracks to come to an income source. The big hitter items with this, you don't need to file your taxes for it, and we don't need to see your. I actually don't want to see your taxes when we're doing a bank statement loan. It's a really good way for us to accurately see what it is that a business owner is making without looking at tax returns.
And one of the questions that we get a lot is how many do you need? So, can you talk to us a little bit about, 12 to 24 months and then, personal and business?
Absolutely, yeah. So basically, what you need, the minimum is going to be at least 12 months of bank statements for us to verify with. I can use personal or business bank statements, essentially depending on what kind of business it is that person runs. So we will run into individuals who are property managers, for example. I think that's a really good one where they have multiple business accounts where they're collecting rents from different rental ventures that they're managing, but they transfer those deposits and their income portion of that to their personal bank statement. So I want to see their personal bank statements. Whereas there are other industries where I'd want to see just business. So very case by case with that, but I can take both. And there's not really a big underwriting difference that we're going to take when we look at both. I bring up 24 kind of in the introduction to bank statement loans because I will actually give a rate discount if I can get 24 months of bank statements to highlight that we have a more long-term borrower in place.
Yeah, I think that's a little unique too because some of my partners I know there isn't a difference in pricing or sometimes it changes. So it's good to know that, if the borrower is willing to pull 24, that they could get a little bit of a pricing advantage with that.
Absolutely. And from our perspective, we look at it as, hey, look, if this borrower is willing to play ball and show us that they have these consistent tracks of income, regardless of what their tax returns may say, we feel compelled to give them a little bit of a break because there's less risk associated with that. We can see 2 years of historical income. We senior management here likes that quite a bit.
Yeah, that makes sense. And, we don't want to glaze over who this is for. So obviously we've mentioned that it's for self-employed individuals, but can you tell us a little bit more about, who this particular bank statement loan is for?
Yeah, great question. So, I mean, you hit it on the head. It's self-employed individuals. Um, I think to put it very bluntly, there are direct incentives for filing taxes a certain way. And filing taxes a certain way can cause borrowers to show that they may not have as much income as what they're actually making. Bank statement loans are perfect for that borrower because it's an alternative to refiling taxes and paying a higher tax bill on the business that you're making and that you're earning. We essentially will use those bank statements independent of the returns. I think this is also useful for any borrower who has not filed tax returns yet in the current year. They have an extension or their taxes are delayed for whatever reason. I don't have to have your tax returns filed to be able to pivot to bank statements. Bank statements are readily available every single month, on time, on schedule, super easy to pull and verify. So that's kind of the target with the bank statement loan.
And we talked about what's needed, the 12 to 24 months statements. Is there anything else that you would want to mention that's needed that seems to come up that maybe a borrower might not be prepared to provide?
Yeah. With Lensure specifically, something that I love, and I think this makes our approach to bank statement loans very different. It's something called a self-employment questionnaire. And so with non-QM lenders, like I said, this is a staple product. Most every non-QM lender has something like this. On every bank statement loan, your lender is going to calculate what's called an expense ratio. Basically, what that means is that, hey, we can see that this borrower makes money, but every business has expenses, from payroll to rent to cost of goods that you're manufacturing or selling. There's money that's going back into the business. And so for some lenders, they're going to have what we refer to as a fixed expense ratio. I mean, they're going to hit your business profits and deposits the 50% expense ratio, and they're just going to cut that in half, regardless of what it is that your expenses may be. Other lenders are going to have what I refer to as a pendulum risk expense factor, where essentially they're going to say, hey, if depending on the industry, we're going to give you a break. If you're a realtor, we'll hit you with a 25% expense factor. If you're a restaurant owner, we're going to hit you with a 70% expense factor. What makes LendSure a little bit unique and something that we require for any bank statement loan is this self-employment questionnaire. It's 10 questions. I think of it almost as a structured LOE or letter of explanation, excuse me, where we're going to ask you about all the relevant expenses that you may have with your business, from payroll to rent to costs of goods sold to cost of manufactured goods. We want to understand how you get paid and how your business earns revenue. We're going to take that self-employment questionnaire and we're going to custom make an expense ratio for your business. So rather than having a fixed or a fixed expense ratio that needs a CPA letter to move that, I can hit a borrower with a 12% expense ratio if it makes sense based on that self-employment questionnaire. It's an amazing tool for your borrowers to use to be able to say, hey, this is exactly what I'm paying for my business. I shouldn't need to be cut further from that. And it allows us to derive more income in most cases.
And what would you say is the minimum expense ratio that you guys will accept?
Yeah, our minimum expense ratio is 10%.
That's pretty standard from some of the other non-QM lenders that we work with as well. What I think is unique is what Tyson mentioned is that they just go off of the questionnaire versus the CPA letter. And the questionnaire, how long would you say it would take that, business owner to fill out?
Maybe being very aggressive with an estimate, I'd say probably 10 minutes, especially if they know their business really well and can say, hey, this is my average for payroll. A big thing I like to hit with that is we're looking at historical averages as well. So we'd want to know on average in the past 12 months, what did you pay for your business to operate?
One of the other common questions that we get is, how long does it take to close? How quickly can I close? So what would you say to that question?
Yeah, absolutely. My staple answer is 30 days or less, but I like to try to be a little bit more specific. Depending on the specific situation, we've closed owner occupied transactions with bank statement loans in as little as 2 weeks before for a very clean deal. Really, it's going to kind of depend on how clean that is. Our process is going to involve getting those bank statements up front. I actually have an AI machine. It's called Prudent. That's going to spread those bank statements for us. So you won't have someone manually reading every line of your bank statement, trying to understand what the deposits are. We have a system that can spread those bank statements within about 15 minutes on the aggressive side. So we have income ready to roll and ready to rock right from the get-go. We do kind of a pre-approval underwrite that can take 2 to 3 days upfront, where I actually take the entire file, present it to senior management. Once that's done, we have an approval from my underwriter's boss's boss on every loan that I do. Meaning that we can disclose on it, we can get it moved to underwriting. Theoretically, every conditional loan approval that we have should be very clean, allowing your borrowers to have a very clean and quick experience, so long as we can turn those conditions around quickly.
One of the things that you mentioned that, we didn't touch on yet is that bank statement loans can actually be used for owner occupied properties, which is what we were talking about, but they can also be used for non-owner occupied properties. So do you want to touch on that just a little bit?
Yeah, absolutely. So I think that's a great point to bring up because obviously we think about owner occupied properties. I can use it for both indiscriminately. It's really just an income type. So we're not going to restrict how you use that or where you use that. I don't have a loan to value cut or a down payment requirement specific to bank statement loans, other than our general program. So the way we look at bank statement loans is, hey, this is the way that the means by which we're verifying this borrower's income. It's very malleable outside of that. I can apply it toward a non-owner occupied, an investment purchase, really any type of business that you may run across or that you may operate.
I helped one of my clients purchase an investment property using a bank statement loan. And, we were able to do that because, he was self employed. And the reason why we did it is, we're going to get into DSCR here in a minute, but there was a slight pricing advantage with the bank statement loan. So, just by having the option and having the knowledge and expertise and knowing, that we could look at something else that was available to him, we were able to get him a better interest rate on the same solution that we would have been providing, getting him that investment property. But instead of using a DSCR, we used a bank statement loan. So pretty cool. Is there anything else about the bank statement loans that you would want to kind of mention before we moved on to DSCR?
Yeah, I think the only thing that comes to mind is a pretty simple anecdote, because I think I definitely highlighted, hey, maybe you haven't filed taxes, maybe your tax returns don't look favorable in terms of presenting income that we can use to verify. Recently, we funded a loan for a borrower who filed his taxes and did a pretty good job with them. He showed a good amount of income, and the loan came to us because we were trying to qualify. We were essentially trying to qualify it for a DTI at 52%, which we've shown the capacity to do at times with a full doc submission. But I knew he was self-employed. This particular borrower runs a podcast, and so I asked to see the bank statements, and we were able to derive. I want to say it was 30% more income than what was on the tax returns from using his bank statements. And so again, I think this is something where anytime a loan that actually calls me on is brought up, we're going to look at it very independently, and I'm going to try to find a way to make it work with the path of least resistance. So rather than trying to get an exception from management to go to 52% DTI, we brought in 12 months of bank statements, and we had this loan done at 38% DTI. And it was clean, and it was easy, and it was not a hard process at all. So I think that would be the only thing to add, is that it's something that we like to, I love to use. We're the subject matter experts on bank statement loans. And we're excited to do them, honestly.
Yeah, I think, that's a great point that, oftentimes the power of the bank statement loan, and I'm fully transparent with my clients, and I'll tell them, you're probably going to have a little bit higher interest rate than you would with a conventional loan, but you can qualify sometimes for 3 to 4 times more home, if that's something that's important to you. So this can unlock the home that you want to get for your family by utilizing a different product and having a slightly higher interest rate. So, we want to be able to provide those solutions. And this is one solution that, we have great partners like Tyson who can help us with. And, I love bank statement loans as well. I think they're fantastic. It's a great tool, and it's a great way for us to help our self employed borrowers. So, moving on to DSCR. So, also in the non QM space, non qualified mortgages, and very popular product. This specific one could be self employed, but these are for investors. So let's get into a little bit about what it is, and then we'll get into kind of who it's for.
Yeah, absolutely. So DSCR, if you've heard of it, great. If you haven't, I'm going to tell you what it is. The acronym stands for Debt Service Coverage Ratio. A more simple way to think about this is a cash flow loan. So as Ashley said, this is designed for investors. And when we take a loan like this, you can take the term DTI and throw it out the window. I no longer care about how much you make and whether or not you can afford all of your other credit payments. All that we're looking at is our subject property, the property that you're looking to purchase or refinance. I want to know whether the rents that you are receiving or that you will receive will cover our mortgage payment. If they do, that'd be considered a 1-to-1 ratio. The way to find that is to take the gross rents and divide them by your payment. Simple as that. Now, oftentimes when we talk about the DSCR space, most lenders want to see a 1-to-1 ratio, meaning that property cash flows perfectly. Something that is a little bit more new age and nuanced is that we can actually do this with maybe a property that doesn't ratio. So if it covers 75% of that payment, that's something we're still pretty open to lending on and getting you into. What makes this product especially popular is the ease of use. So if you're an investor who has more than 2 properties, you've gone through the hoops of providing real estate owned documentation for every one of your properties. to verify rents, to verify your mortgage payment, your taxes, your insurance, if you have an HOA, on top of all the regular documentation you have to provide for a mortgage loan. With the DSCR, we're not looking to get all of that. I don't need to know what rents you earned on XYZ property down the road. I only care about our subject property and that you make your payments on time. That's really it. So the ease of use is huge. Makes acquiring new properties very easy.
Yeah, you made a lot of good points there. I didn't want to stop you because you were on a roll. Um, some of the points that I want to highlight are the ease of use. So, yes, if you have multiple properties, this is going to be a great option for you. Another thing that we come across a lot is that, you're only allowed 10 properties, and sometimes it's not even 10, depending upon the lender, in your personal name. So when you have, and those are financing. So if they're paid off, it's different. But if you have financing for 10 different properties, banks are not going to give you another one for the 11th. And sometimes, even if they're commercial loans, sometimes banks will cut you off. So I had this opportunity with my contractor back home in Pennsylvania. He had so many different properties and financing on those properties, investment properties, that the bank said no more. So he came to me and he said, "Hey, can you help me with this?" And we did it with ease, and we knocked out 2 in 2 months. So it's a great product for various reasons. Not just if you're running out of, opportunities because you're capped, not just if you have a ton. You might be just an investor yourself and you don't have a W 2 income. So this is a great option for you as well. But we really try to tailor the loan solution to you rather than the other way around. So we don't make you fit the box. We want to make the box fit you. And so we really build and craft a solution. And this is one great option that, I have a lot of experience in. And thankfully, we have great partners like Tyson who can help us with that. And so, we touched on, who it's for. It's obviously for investors. So I just want to hit the point home that this cannot be owner occupied. So it's a great product, but simply put, you cannot live in the property and occupy it in any way. So it does have to be non-owner occupied. And, I think sometimes, like, when we think investors, we think, well, this is my first time. And like, I don't know if I'm considered an investor. So, Tyson, can you talk about that and kind of how first time investors are treated at LendSure?
Yes, absolutely. We love first-time investors. That does not disqualify you from doing this type of a loan. We can get you into these cash flow loans or these DSCRs with as little as 15% down if we're at a 1-to-1 ratio. So if that property cash flows and you have 15% down, we're open to lending. If you are a first-time investor, that does not, like I said, it doesn't preclude you from doing it. Typically, there's going to be a small pricing adjustment of about 0.25% to rate. Is really the only thing you're going to incur for having not invested and this being the first time you're doing it, because there's slightly more risk that we're adjusting for.
We're kind of talking a little bit more about, like, the individual, because there's not a whole lot about the individual that we really care about for this loan. But one of the things we do care about is their FICO score. So can you talk to us a little bit about, the minimum FICO score, kind of that barrier to entry, and then, what pricing tier is going to give our borrowers the best interest rates and really kind of maximize, getting, the best pricing?
Absolutely. And so our minimum FICO score generally is 660 to get into a DSCR product. Something unique about LendSure is that we are very open to making exceptions. So that 660 is a little bit of a floating target. I've funded loans with less than that before if I had sufficient compensating factors to get it done. The other big piece pertaining to your credit that we're going to look at is mortgage payments that have been paid as agreed for at least 24 months. I'm going to walk that back again because I also funded a loan a couple months ago where we had a missed mortgage payment prior month. There's a good reason for it. Their servicer had changed and they didn't know about it. So we were able to get past that. But it's definitely something where, in an ideal world, we want to see that for the past 2 years, every mortgage payment has been made on time. As far as pricing tiers and where you're going to want to be on a loan like this, find that the happy medium is about 75% loan to value or 25% down. realistically, that's going to be where there's a bit of a break in pricing, and my 60% LTV to 75% LTV price is all exactly the same. So if you're putting 25% down versus 40% down, we're going to be kind of in the same boat there. There may be specific adjustments on specific loans, but that's a good spot to be in. And likely you're going to ratio, or you're going to be at a 1-to-1 flow on that property when we're at about 25% down. So that's a nice happy place to be. Yeah.
Yeah, I love that. One of the things I'm super passionate about is maximizing the purchasing power for my buyers. So, you know, I always want to find out what it takes to really maximize with that particular lending partner and let my client know. And, it's up to you if you want to put 25% down or not. If the property is profitable enough, you don't have to, and you have a great credit score. But I always like to let you know, hey, if you want the best of the best, here's what you got to do. If you don't, that's okay. We can still do it and make it happen this way. So I appreciate you sharing that. What's needed? So this is one of the great things about the DSCR loan. We kind of touched on it, but let's kind of just summarize what's needed for the DSCR loan.
Absolutely. We need a credit report, and we need the last 2 months of asset statements to source and season where your down payment is coming from, and then up the property that you want to buy. Right? We need that address, contract, and that is it.
So as you can tell, very low document loan. So again, sometimes just that ease of the transaction and not having to provide tax returns, not having to provide pay stubs if you have those. It's a great product, and it is great pricing. So very competitive to our conventional investment products. And you can do it with a low document option. So really cool. How long does it take to close these? So let's talk about that.
Yeah, these ones can be super fast. A lot of it's going to hinge on the turn time of our appraisal. If we're acquiring a property, because I have to have an appraisal with market rents. I will say we've closed. We in the past, I've had loans that have come to me as a result of fallout. So we've already had an appraisal. And with those loans, I've closed them in as little as 5 business days. Um, Typically with loans, and actually, you may be better to explain this. Typically, we have a requirement to follow called TRID. It's a government enacted timeline telling us disclosure timeframes that we can't close for at least 7 days, that we have to send a closing disclosure with a waiting period, and with investment or non-owner occupied transactions like a DSCR, I don't have to abide by TRID. We don't have the same waiting periods or timelines, so it's completely possible to close these extremely fast. Again, in part, it's going to depend on, hey, how quickly can we turn an appraisal around? We have an appraisal already, there's nothing to stop us from getting these in and out within a week or so.
Definitely valuable information. I think, it's fair. We like to target around 25 days. Certainly we push for faster than that. But if the appraisal, which is out of our hands, it's a third party, is a little bit longer, we're probably looking at more like 30. But typically, I mean, these aren't longer than 30 days.
Definitely.
So that might be something that you thought, this product's so great. Like, what's the catch? Is it 45 days? No, it's not. It's actually just the same as all of our other products. So one thing a common question that I get a lot is, so how do you calculate the rent? Like, I'm going to tell you what the market rent is. Do you just take my word? Like, how does that work? So, I'll refer to Tyson here, but typically how it works is that, yes, at the beginning, when we run our numbers together, I'm going to ask you what the market rent is. And from there, I'll kind of do some homework, make sure that I feel like we're on the right path, because that number is so important, because you can see that the loan and qualification is based on it. And how it's supported is, Tyson mentioned, we order that appraisal. And in that appraisal, we add on another feature where we ask the appraiser to also provide, in addition to the value of the property, we ask them to provide the market rent. And we can actually, which is something we didn't talk about, we can actually specify a long-term or a short-term rent. And so the long-term rent is very common. And what we're going to do, and Tyson, you can correct me if I'm wrong, we're going to take the lower of the two. So if you have a tenant in place and let's say the rent is $1,800 a month, and the market rent comes back on the appraisal at $2,000 a month, we're going to use the lower of the two. Is that how you guys approach it?
That's correct. Now the inverse of that, just I guess to speak to that scenario, say that the market rents on the appraisal came back at 1,800, and the tenant in place was paying $2,000 a month in rent. If we can document that you would be receiving that rent, if it's a property you're refinancing and you have that tenant, we're looking for your bank statements. If it's a property you're acquiring and that tenant's going to stay, you'd be looking for receipt from the seller. Essentially, if I can get documentation saying, hey, this is the actual rent number, I'll use the higher if it's documented actual rents versus market rents from the appraisal.
So that is a little unique. So that's really special, and I'm super glad that we talked about that because that's a huge thing. Sometimes it comes down to the wire because you want to put the least amount down, and rightfully so. And we're running close on our ratio. And if we have a lender in place like this that allows us to do that and have the flexibility, then we can close that loan and still get you that lower down payment, and we can do it this way. And that's not every lender out there. So that's really great. Short terms. Let's talk about that
Yes.
really quick and then we'll kind of wrap things up. So, short term rentals have become more popular over the years. And thus, lenders are really kind of adapting to that demand. So, can you kind of tell us a little bit about, you know, short term rentals and how we can help our clients qualify for those?
Yeah, absolutely. It is surprisingly more simple than what you might think that it is. Realistically, it's something that we're going to ask at the pre-approval stage what your intention is, whether this unit that you're purchasing is intended for long-term rental leases where you have a tenant who signs a lease and is more the traditional renter that we think of, or if your intention is to use short-term rents and put this unit, this property on Airbnb and Verbo and all these other places to capitalize kind of a market. When we order the appraisal, we will add that additional feature that Ashley mentioned, and we will ask for the appraiser to verify short-term rents and get us comps for that. Typically, they're going to use a service like an AirDNA, which is an Airbnb provided service, telling us what comparables are in the area, what they're making. So something similar to that for different companies is what they're going to use. And they will give us a rental figure based on what they estimate that property would make on short-term rents. Now, the way that we're going to look at that, we may be able to use 100% of that short-term rent figure from the appraisal, depending on what our loan to value and FICO is. And the guidelines are if I'm at 65% loan to value, 35% down, and a 740 credit score, I will use 100% of the short-term rents. If either of those metrics, if I have a 735, I guess we probably would do that. If I had a 715, for example, at 65% LTV, I would need to use, we can get approval to do 80% of those short-term rents. So we'll use most of them, but we want to try to, cushion for the risk a little bit and make sure that we're not over our skis.
Again, I can share that that's unique. We work with a lot of great lenders, but LendSure has a little bit more of an appetite for giving us more credit for the income that is projected. So, for instance, some other lenders in the industry are going to only use 75% of the income that comes in on the appraisal. So, you're getting a haircut that's pretty significant. And with short terms, typically they're so great, they cash flow wonderfully, and rightfully so, they're more work, but it's nice to know that if we are close, we have a great option that they have more flexibility that will allow us to count more of that income. So that's definitely unique to the industry. So is there anything else with DSCR, short term, long term, that you would want to kind of share before we wrap things up?
Yeah, I would say the only thing that we haven't touched on that I think is important to mark on is that this is a product that's available for more than just like single family residences. And so we obviously will lend on your single family homes. We'll lend on townhomes. We will lend on condos where it starts to get a little bit more unique as we broach that short term rental area. We can do this on condotels. So your condos that act as a hotel and have a check-in desk and a management service for you as an investor to basically turn it over to this complex and let them manage your tenants and take care of your property. I can also lend on those projects. And the other one I get questions on a lot is duplexes, triplexes, 4 units. We actually can do a DSCR loan on up to an 8 unit property. So what 1 to 4 is where it's going to be a lot friendlier. 5 to 8 is where we open a little bit of a can of worms. But this is something that's available on really any property that we can find that's going to cash flow positively.
Yeah, that's great. I'm glad that you mentioned that because definitely, unit count is something we want to talk about. More and more common that, investors want to purchase not just single families, which are fantastic, but also, duplexes, triplexes, 8 units, whatever it might be. So appreciate you sharing that because we didn't talk about that. I think we're just going to wrap things up. Tyson, thank you so much for being with us. We appreciate your time, your expertise. I appreciate you being my partner. And hopefully everyone in the audience learned something that they can take away. If you have questions, please reach out. I'll share my information in the comments, and then, we can get together and hopefully discuss your next deal. Thanks, guys.